Sorry, guys. I guess it would really help if I turned the audio on, huh? It's a rough morning. Let me restart. We got 8 ECB speakers today, quite a bit of them. There was a little bit of a rocket issue. It turns out that it was just system defenses. It was not a deliberate attack on anything. Things kind of shook around a little bit and then stabilized after comments came out. Just kind of it shook the FX markets, and of course that ripples across everything else. We do have production numbers today in retail, and retail ties in really nice with what happened in Walmart yesterday versus what happened in Target today. And like I was talking about yesterday, Walmart or Target as a company, market weight, they're not big enough to move this market. But the things that they can say are most definitely enough to move this market. So definitely watch the clock today with all these different Fed speakers. For the most part, they're going to continue to sing from the same hymn book. They're all holding the same message, and they're doing pretty good at it. They're getting better at parroting each other and not getting out of line, right? For now, I mean, they're not going to be able to keep it, but as long as none of them start showboating and trying to, outshine their group, and they just can toe the company line, then we shouldn't get anything extreme out of the Fed speakers. We have an 80% chance of a 50 basis point rate hike. But between yesterday and today, they've been increasing the chance that we have a 75 basis point rate hike. If this starts to accelerate, we're going to see the market go down more faster. They'll be pricing in 25 basis points. A lot of the Fed speakers today are going to have a direct impact on this right here. And this is for the December 14 FOMC. And here for the February, they are also pricing in a bigger rate hike. It's just started to do that, but they are starting to do that. So this is something you're going to want to revisit again later today. You don't have to sit and watch it all day long, but sometime around noon, take a look at it, and then closer to the end of the day, take a look at it. See if it's continuing to change this bottom line, the 500 and 525. And then for the December, it's the bottom line, 450, 475. So keep track of those and see if those are continuing to increase. It'll show they're pricing in a 75 basis point rate hike. It's going to drop that market down. All right, so I was on TradingView here, pointing out this head and shoulders from the October lows and how we had made 50% of that measured move. And when you have a measured move, the two common ones is 50% of the move and then 100% of the move. And when we made the 50% and fell away, it was kind of like, well, that's a wrap. It's done. It's over with. Then with the CPI and the PPI and the market turning around, we made another run. And now we've made it to 100% of the move. Depending on where you draw the head and shoulder lines, and where you draw the neckline and all of that, it affects where the measured move is. So there is an argument to be made that we hit the measured move on Friday. I argue that it doesn't matter. When we draw trend lines and measured moves, don't imagine that you're using a sharp pencil. Imagine that you're using a fat, dull crayon, big, thick lines, big zones, areas. So this entire area is a part of where that measured move would end, especially on a daily time frame. And just like before, when we made it 50%, we hit our target, consolidated for a few days, and then dumped out of it. If we call Friday having hit the target and we got 2 days of consolidation, we're ready to dump out of it. Either way, that head and shoulders is done. So once you've got your measured move, that's it. You don't continue to look for more bias from the same measurement. So that head and shoulders kept our bullish bias in check, kind of helping us with that upside target. But it's done. It's over with. So no reason to have that on there anymore. We still have a gap close to deal with. And the fact that we got so close and didn't hit it is a little bit concerning. 40.37 is the bottom of that gap close. Target 2 is the top of the gap close. It's the, not saying it like another way, this is where we're supposed to be to close that gap. If we don't go to 41.11, the cog line, then the gap's not closed. So my argument is that we're still in consolidation after having made a significant move up over the last few weeks. And because of what happened with CPI, we were overbought. And I hate that phrase. I hate that sentence of overbought. But when you're that far away from the 10-period moving average, there's not a lot that you can call it, right? Overextended, overbought. We moved too far, too fast. Just say it however you want. We need to pause. We need to consolidate. At the moment, this market has not turned bearish. We're IX10 at this point, and that red to green yesterday that failed, that's a little bit of a concern, you know, for a bearish argument. That was a really great red to green setup yesterday. I mean, it was beautiful, textbook red to green setup, and it failed, miserably failed. Kind of leads a little more argument on that idea that the current run is done, but I don't think we're done yet. Not looking at the flows and everything else. We do have energy today at 10:30. We don't have any auctions today. I think the next time we have an important one, it will be on Friday. Maybe it's Thursday. Thursday. Lots of auctions tomorrow to deal with. So we still need to parse the report from Target, see what that CEO has to say. Their comments are going to directly affect outlook on inflation and how businesses are doing and inventories. Remember, all of those major stores had like a significant inventory issue. First, they didn't have enough, and now they've got way too much. It ought to be an interesting Black Friday. This is the expected move range for the week. That gray line in the middle is where we closed on Friday. And we are still sitting right there. We've basically, since Friday, done nothing. A whole lot of running around, and we were right back where we started, like a hamster on a wheel. I'm still going to contend that we're in IX10, since that wick does not change my opinion. That's a little bit of an argument on that. By the way, some analysts will consider the IX10 done or an inside day broken as soon as we leave the range, but we didn't close outside of it. So I still contend that we're solid. However, that move yesterday did take out or adjust any open interest on the top of that box. So outside the cog line 40.11, it would have moved all of the open interest up above 40.50. Just like the last few days, volume's a little light near the 100 mark. This is cumulative volume since midnight. It's a simple metric. We're looking to see if it's really, really low, which would imply the market's waiting on something, or if it was really, really high, showing the market is reacting to something. And neither one of those are happening, so we just turn it off, get it out of the way. We're starting to get more and more pivot points, just kind of clustering up everything, making it really crowded. This is the range that we're dealing with. It's the range we want to continue to focus on. Now, there's plenty of room here to trade, and I'm not arguing that you should sit out and not trade it, but I am going to point out that it will be difficult to trade in this environment. Looking back, those candles look tradable, but during the move, when the candle is live and it's moving around up and down, your stop is going to have to be far enough away to avoid getting tagged. And it's just randomly changing directions through all of this. I always talk about a consistent message in the market when you're trying to trade. When everybody's on the same page, it's really easy. And when we say they and them and those institutions, and we're referring to what the institutions are doing, there's a lot of different institutions out there. So some of them are long and some of them are short, and almost all of them are trading the futures as a hedge. They're not trying to like get in here and get out there and make $1. They're using these as a hedge against another trade that they're already holding. So it's not always easy to see when everybody's on the same page, and most of the time they're not. One group is going long and another group is going short, and they're passing the buck from one side to the other. And that's when it's really hard to trade. But when everybody gets on the same page, when it's a clear, consistent market message, it's one of the easiest times to trade because there's no confusion about where the market's going. Everybody's doing the same thing. So for an example, on Friday, when we ran up off of these lows and we had nonstop candle after candle, higher highs, higher lows, a clear, consistent message nonstop all afternoon. There was no doubt or confusion or hesitation about who was in charge. And you take something like Friday and then look at Sunday night when it was a very narrow range and we were just bouncing up and down and back and forth with no clear, consistent message, never quite trusting, is it going to turn here? I don't know. What about the lows? Are we breaking out yet? No. So if you're finding it hard to trade and you're getting chewed up, why not look for an easier market to trade? And when it's not that, you just don't trade. I know I said the horrible, dreaded don't trade, but you know, survival, especially for you small account traders, should be more important than getting the thrill of a trade. We are back inside the box from the previous week's high. We got outside of it yesterday. I wrote a little bit about this yesterday, but that PPI print should be considered like a gap that needed to be filled. It's a liquidity vacuum. And so after we spiked up, we spent all morning coming back down to close that gap. And then we dumped. Now, you can argue about whether you knew where it was going to stop or not, or you had a good idea where the reversal would be. We had yesterday's low pivot. It was a quarterly level, and it was 100% of the measured move of that big candle. So if you had measured that big candle and plotted it to the downside, it would have given you price targets right around there, which matches that quarterly level and the low of yesterday. Did we know it was going to turn there and run back up? No, nobody knows that it's going to do that or not. But it was the spot for a first touch bounce. Those counter trend trades are usually really great for, 5 or 7 points. And when you got enough contracts, 5 or 7 points is all you need. The ADR continues to shrink, and the longer that we are in this sideways range, the more this ADR is going to unwind, right? When we make big moves, the ADR gets big, makes sense. And when we quit making big moves, the ADR shrinks. So we're continuing to see a smaller ADR. Right now, half an ADR would be 40.38. Then we have the high of yesterday at 40.50. Then we have the full ADR at 40.85. That'd be the top side argument. Downside, we would need to get through the close of yesterday or through the Globex open of last night. Then our own Globex low at 39.80. Then we have a retrace level, which also is the Globex low from yesterday, 39.72. Cash low of yesterday, 39.60. Half an ADR, 39.45. And the full ADR at 3,900. And to get down to that, we would have to get through the weekly pivot point at 39.15. And I argue that's close enough to a cog line that you would want to focus on 39.11, not 39.15. So we got a lot of pivot points on either side. We have a really narrow initial balance this morning too, which kind of implies there's work left to be done. We talked about the 200 period moving average yesterday. We hit it. We still have the 200 SMA at 40.75. We have the 200 EMA at 40.28. So they're about 50 points apart right now. And that 40.28 200 period daily moving average is our resistance that needs to be dealt with. But even if we do get above it and close above it, it's that SMA that we rejected off of back in August. So the market does respond to that EMA. But the SMA was the smackdown with the line in the sand. Ten-day, 30-minute volume profile. The point of control is with us now. It's no longer below us. Should we break below yesterday's low, we are going to get into this shallow volume area. It's often referred to as an air pocket. So if you drop down below that, we're very likely going to move through that level very fast. Now, yesterday we had the point of control down there. So if we did fall and move through the air pocket, we were likely to end up around that point of control. But now the point of control is with us, or it's up there at the top. So there's nothing really to catch us or assist us or slow us down until we get into this price action back here. And that is from November 18. That would put us at around 38.50-ish, right around in there. And there's not a lot to this, so I wouldn't expect it like a handrail. I wouldn't lean on it and trust it. Maybe a first touch bounce at the most. We do have a point of control from yesterday to carry forward, that VPOC. It's a virgin point of control. It's called that because it hasn't been touched. It's where you can't make this stuff up, right? Dead cat bounces and virgins. And so if we do get that topside breakout this morning, we want to focus on that VPOC. This also is not going to be like a handrail to trust and lean on. It's going to be more of if we break out of the top, that's going to become like gravity. We're going to move to it. First touch bounce says we'll probably reject off of it at least once. And that rejection, it doesn't owe you the moon. So a fall back off of that few points, 5 to 10 points, it's enough to get day done. But I wouldn't expect it to be any sort of like significant resistance that would stop the market from continuing its upward move if we do break to the upside today. We'll now carry that VPOC forward until we do hit that level. Same with these lower levels, these lower VPOCs. All right, so the other day we talked about how far away from the 10-period moving average we were at. And if you think of the 10-period moving average as the center of the basketball court, when you get to the edge of the court, there's really nowhere else to go, right? You can hang out on the edge of the court or you can move back towards the center, but that's really the only two choices you got. So when price outruns the 10 and gets, quote, too far, we expect it to pause and stop. But every market has a distance from 10 that is unique to that market. Tesla, Apple, Amazon, the futures, they're all going to move differently away from that 10. So I made this indicator, and that way we could look at each market and decide, all right, well, what's the average distance from 10 that it gets to before it tends to turn around? And for the ES this year, or within the last year, 2 years, we can see that getting beyond 2.5 and into 3% away from the 10 period daily moving average is generally about as far as it likes to go. At that point, it generally pauses, consolidates, and or falls back towards the 10 to reset the move. We made that the other day. We were nearly at 4%, which is the highest levels we've been away from the 10 in the last 2 years. So when we say overbought or have we moved too far too fast, yeah, we outran the 10 and was nearly 4% away from it. Then we have the other metric, which is 10-week. This also made it nearly 4%. And again, showing that we had just moved too far, too fast, and needed to pause and consolidate. So over the last few days here, where we've been just kind of holding the line and not really going anywhere, we can't see that as bearish yet. We don't have a bearish signal. Just because we're not advancing doesn't mean we're going to decline. So I would caution people about taking short trades yet, because we don't have a short signal yet. We don't even have a short trigger yet. All we've got is a market paused and consolidating. Now we talked about this white line running through the center of my chart. It's a linear regression line. And generally speaking, you get on one side what you get on the other. So if you get a 1.5% move one way, you're very often going to get a 1.5% move on the other side. And the same thing goes for RSI and MACD and all kinds of things. Reciprocation. When it comes to these sweeping moves, sometimes we get stalled before making the move. And when we're ready for the sweep to come back up, we get stalled and we have to reset and try again. It makes perfect sense when we can think about the idea that markets don't move in a straight line. So when we had this move to the downside here, this big move was from that big move. So those two kind of set the bar or reset everything. So if this move is the one that we're measuring, then this move is the reciprocation of that. Right? Hopefully that makes sense. This level and that level are the same move. Just like this one and this one are the same move. Right? So if we're looking at it from the linear regression point of view, this run is done. We've got linear regression that says the run is done. We've got the head and shoulders measured move that says it's done. We got the 200 period moving average, which looking back at, how many times the S&P in a bear market took a rejection on the 50 and the 200, as a lot, but that's not enough, right? That provides a little insight, but that's not enough to call it a rejection. You got seasonality. When you overlay this chart with the 07 market and 08 market, you can see how they're very, very similar. And there's a guy on Bloomberg who uses his Bloomberg terminal and posts it out on Twitter with that overlaid chart. It's kind of freaky how close this market resembles the market we had back then. So a lot of things are saying that this run is done, but we don't have a trigger yet and it hasn't broke down yet. So we can't really short it yet, but everything's pointing to this being over with. Real quick on the dollar. Yesterday, we had that strong break to the upside after the 1 o'clock. I mean, on the dot, 1 o'clock, the dollar took off, the S&P broke that structure and headed to the downside. Well, I love watching the clock. But notice US dollar to Japan did not respond the way that we had been seeing it lately, right? I had been pointing out over the last 2 weeks this really tight, amazing correlated market state where, you know, Japan would make the move and the dollar would respond and the S&P would make an inverse move. It was beautiful. That's decoupled and broken, at least for the time being. So I'm not going to say don't watch the FX markets. Of course, watch them, but you know, they don't have the same weight right now at the moment. In fact, when I was looking around at all the markets yesterday, the FX markets on this move, I didn't see it in them like you would expect to see it, or like we were seeing it. But we certainly did see the breakdown in the S&P on that move. All right, Bitcoin is down, natural gas, emerging markets. And that's kind of my benchmark, is a 50% level, or a 0.5%. So there's not a lot down if that's our metric. And there's not a lot that is up this morning either. If you consider all of this in the middle is still sitting at flat, it's still sitting at 0. So KWEB and emerging markets are not in agreement this morning. Remember that for the last week or two, we've been seeing KWEB up significantly because of the China ADRs and the short covering rallies and just all of that. And yet this morning, we don't have that. And as much as I disagree with it, China is a large part of the emerging markets basket. They really need to change the status of that, right? I thought it already had been changed, but it's hard to see them as an emerging market that needs a leg up. They get all kinds of special incentives isn't the right word, but right, it's like as that status, they get an easier path forward. And you know, an emerging nation trying to rise up and needs all the help it can get. It's hard to see China as that now. Either way, it doesn't matter. They are still a large part of EEM, emerging markets, and emerging markets is down 0.5%, while KWEB is up even just slightly at 20%, or 0.5%. Excuse me, 0.25%. Everything else is basically flat. So there's nothing positive enough to even register, and it's either flat or negative. So let's take a look at natural gas then. We're still kind of holding in that box. We don't really have a lot here, right? We're just don't diddle in the middle. We're sitting right in the same spot we were sitting. We do have a market maker move this morning. And we've got this double bottom, classic double bottom, that so far has held. I really don't like that massive gap up, that big red candle there. But if you go and look at like how IBD talks about double bottoms, and they talk about how it needs to go lower than the previous low, to trap the traders so that when it comes back through, those trapped traders are puking their position, buying back to get out, which adds to the buying, and you get this really big explosive move up. Well, that's all well and good, but we didn't keep it. And notice that that is a green candle, a solid green candle, not hollow like these other. There's another one. Energy is a highly manipulated market. We're going to expect that that's not going to change anytime soon, right? It always has been, it always will be. So I just stress, approach with caution. If you're looking for some big picture trade, we don't have it. We're sitting in the middle of nowhere. We haven't broke out of the range, and we haven't broke down from the range. So if you get in now, you're getting in before we have any signal to do anything. %17% of the S&P is down this morning. We're just in a real sideways market. Nothing is really down or up. I always feel like this is a situation where the market is holding its breath, waiting for a reason, right? It's almost like it's just saying, give me an excuse. So market waiting on a catalyst. And sometimes they'll just make stuff up. I use that word stuff lightly. They'll just make it up. They'll blow something completely out of proportion and dump it. Usually, price is making the move, and some bobbing head on TV is just trying to attach some reason for it, whether they can actually validate it or not. And then that becomes the narrative, and everybody says, oh yeah, it went down because a butterfly farted in the Pacific. So waiting on an excuse or a catalyst waiting to happen, it doesn't really have to be anything significant. At least it doesn't have to start out as anything significant. I would keep track of whatever comes out of Target today, right? The CEO, listen to or catch headlines on anything they have to say about inflation. There's a lot of Fed speakers. One of them could screw up, stick their foot in their mouth. It wouldn't be the first time. There's no real big economic catalyst on the agenda. All right, I took the S&P 500 and I filtered it down to nearly 100 names. It doesn't have a choice for me to use the S&P 100, so we have to kind of make it ourselves. Generally, when I set this multiplier down to a decimal level, 0.1%, we get rid of all these gray boxes because it'll take very little for the box to change color. And yet this morning we're so flat and sideways across the board that we still got all these gray boxes all over the place. There's no financials in the NASDAQ 100. So one of the first things I look at when it comes to the S&P is, what are the financials doing? And I was going to bring that up. So let me point this out so that the next thing that I say is going to make more sense. Yesterday on that breakdown that we had in the market, before the breakdown, you had the monsters of tech pressing against the high of the day. They opened way down here, ran all the way up, and they were just sitting in this sideways channel pressing against the highs. But the banks, the regional banks yesterday, opened, gapped up, hovered around their VWAP, stayed within their 5-minute open range, and were testing the lows of that 5-minute open range. So the financials and technology, which are two of our strongest sectors when it comes to risk on, risk off sectors, those are our risk on. Generally, they work together, or at least they don't work against each other. But we've been seeing more of tech versus finance instead of tech and finance. So we had the breakdown in the banks, and we did get the breakdown in the monsters of tech, but they started that breakdown from two different sides of the range. And NY Fang is the monsters of tech. It's like 10 companies, and they're not all, quote, tech. So we do a disservice when we say that this is technology. It's the monsters of tech, but it's not tech. You want to look at XLK for an example, if you want tech. And when we do that, we weren't sitting inside that 5 as tightly and nicely as the financials were, but we were underneath the VWAP, near the lows of the day, just like we were in finance. So these two sectors were completely in harmony yesterday, as they should be. It was the monsters of tech that weren't. This is a basket of 10 stocks, and those 10 stocks are market movers. Their market cap is huge. That's why they're called monsters of tech, right? Except that this ETF does not get rebalanced quickly, and the names that are in it doesn't quite make sense now as opposed to, say a year ago. The names are like Alibaba, Baidu, Twitter, Netflix. If you were to Google NY Fang, you could see the names that are in this. So the monsters of tech are big enough to drive the market. If you think of the S&P with 500 names, and we're talking about 10 strong enough to bully the other 490 into doing whatever they want. So when they joined the move, it was a wrap. I mean, that was the go at that point. So keep track of the financials. I like to use KRE, but you could use, the more broad-based XLF. To me, that's too broad. It's got insurance in it, and trading desks and trading firms and all kinds of ancillary stuff. KRE, regional banks. So monsters of tech are the really big boxes. We can see that Google, a 0.25%, what I would consider negligible. Same with Microsoft, Apple, Tesla. The big ones that stand out is NVIDIA down 1%, Amazon down 1%. Those two are a part of the monsters of tech, and they're down more than 1%, that counts. Facebook is down nearly 0.5%, so it's moving or trending in that same direction. But financials are flat. We're not getting anything really out of them yet. If they join up with these monsters and we start moving, we want to look for a highly correlated market state today. High correlation coefficient. Otherwise, it's going to be the same choppy, waiting on a market, waiting on a catalyst to happen kind of situation today. Focus on those big levels that I pointed out. In the SPX above 40.28 and below 39.50. Things are going to start to get a little nasty if the SPX breaks outside of that level. And if you want to focus on that IX10 pattern, then it'll be a little wider than that. Call it the low of Friday. And that's not a bad argument to make, right? The low of Friday, 39.45. If we stay inside of that, we're likely to just continue to chop and continue to wait for this market to have an excuse, which is what it really is all boiled down to right now, a market waiting on an excuse. It could be from the Fed speakers, and it could be that they're pricing in that 25 basis point rate hike. Let's let the data come out today, play the levels. Everybody be careful, be safe. I'll see you all tomorrow.